Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today in the podcast, the man himself, Mr. Michael Becker.
Hey, Paul.
Governor, how are you today?
Things are going well. Can't complain.
Michael, who has so much real estate, we call him the proverbial governor of Texas. And so how's everything going at SBI?
Yeah, everything's going good. A little slower than we would like. Hopefully we'll change our cold streak here shortly. Paul and I were just talking before we started recording. I hadn't got a deal awarded to me since like September, so it's been a little longer streak than usual here for us.
That is unusual, is it?
A little less inventory in the marketplace today. Seems like that's kind of turning around a little bit right now. Got a bunch of irons in the fire. So hopefully something will hit in the near term and we can correct that problem that we have. So
I know you guys will. So Michael, who's the former banker, turned in from a lender of money to an owner of real estate. So he's done a great job doing that with his group at SBI.
Paul, what do we got going on in the Old Capital world before we get into the podcast?
So two things I want to bring you to understand. We need for you to participate with us on March the 30th, Hoops for Homelessness at SMU, University, SMU, Southern Methodist University. We're going to be sponsoring a 3-on-3 basketball tournament. We've asked you to come and play with us. Now we need your money to support City House. City House is a charity that handles kind of emergency situations, crisis management for kids that are between the ages of 0 up to about 17. So crazy families, these guys take over the kids and help them get them set up right. And we certainly would love for you to participate with us in Hoops for Homelessness on April 30th. Don't forget also, March 30th. Yeah, April 3rd, we have the doctors making a house call. Dr. Dotzer from Texas A&M University, the former chief economist right there, he is going to come and be in-house with us on April the 3rd, Grapevine Convention Center. We need for you to come out and RSVP, go see the good doctor. Go to the oldcapitalpodcast.com website, oldcapitalpodcast.com website. We'd love for you to participate. There'll be 400 or 500 people in that room to listen to Dr. Dotzer. He is fantastic. We encourage you to come and join us. If you are in other cities, jump on a Southwest plane and come on down and watch Dr. Dotzer do his talk. You like him, don't you, Michael?
Yeah, he's very entertaining. So he takes what could be a somewhat dry subject of economic forecasting and make it a little bit more humorous and pretty engaging in the hour so that he's up there talking.
So in the podcast today, we buy these buildings sometimes for tax reasons, not only just for financial reasons, for income and owning a hard asset, but also for tax reasons. So one of the things I want to bring everybody up to speed in the podcast is something that's almost required. And we're going to talk a little bit about cost segregation. So in the podcast today with BBG, BBG is one of the largest appraisal evaluation groups in the world. They brought their guy in here to talk with us a little bit about cost segregation, and he is an expert. So I want you to be introduced to Louis Yori.
That's it.
Louis, how are you?
Good. How are you?
Good. Thanks for coming to the podcast. We appreciate it. Now I'm going to throw it over to Michael, the Grand Inquisitor.
Yeah, hey, Louis. Thanks for coming all the way down from New Jersey to Texas to talk to us. So what we kind of maybe we start with, give a little bit of background on yourself, kind of talk about BBG, what you guys do. We had Grant on the podcast a month or two ago, talking a little bit more on the valuation for the lender's side. Maybe talk a little about yourself and kind of what BBG is from your side of the desk over there.
Sure. Well, thank you very much, and thank you for having me. I joined BBG approximately 4 years ago, and I was brought in as the head of the advisory practice. And what that means is essentially the majority of the work that's done at BBG is valuations for lending, but there's another side to valuation which needs to be taken care of both on the tax side and also on an audit side, and that is valuations that typically go to your accounting firms for review, and those are the ones that, the accounting firms help you book your numbers, and also what they do is they also guide you as what you need to do, and cost segregation is one aspect, purchase price allocation is another.
Okay. So, yeah, maybe just kind of talk high level. What's kind of the easier one? I don't know if it's the easier one. Maybe start with the purchase price allocation. And before we get into the cost segregation, what does that mean? What the heck does that even mean?
Sure. A lot of people may not know what it means, but sometimes the accounting firms will ask you to get a purchase price allocation. Essentially, how it starts is if you are a client that's reporting under GAAP, which is generally accepted accounting principles, if you make an acquisition, the accounting firm needs to know what the value of the assets are that you acquired. And what we'll do, for example, is say if a fund buys an office building, what we need to do is we know what the purchase price is, they've acquired it. But what we need to do is we need to break out those assets into a number of different categories because they're depreciated for accounting purposes at different rates. So we'll break out the value of the building, we'll break out the value of the land, the site improvements. We'll determine whether you've got above market leases or below market leases. We'll value the leases in place and any other particular intangibles that may be associated with the property. So they're all broken out and they're then adjusted to the purchase price. So now you start your balance sheet with a number of assets on there that are correctly valued.
Is that as critical for, say, an apartment building as it would be an office? Because you don't have above or below market leases, I wouldn't think, right?
In an apartment building, you don't, but you still need to break out the land building site improvements and also the value of the leases in place. And the value of leases in place is something to think about it this way. If I buy a building fully occupied or empty, I'm going to pay more for a fully occupied property. That's how we look at the value of the leases in place.
Not to get too deep in the weeds, can you then amortize or depreciate down the value of the leases in place?
Yes, exactly. That's what's done.
Okay, cool. Blessed to learn something new today. So one of the things I've been doing since I bought my first apartment building, 30-some buildings ago, is we pretty much done the cost segregation studies on all of our acquisitions that we do. So kind of near and dear to my heart. I've been doing it before it became a little bit cooler here lately. But maybe you just kind of start. What's the cost segregation study in general? Why would you do one of those?
Sure. One of the aspects of buying real estate is you've got a depreciable asset. And under tax reporting, as opposed to what I mentioned previously was GAAP reporting, under tax reporting, what we need to do is break out the building components, but we're not looking for the intangibles so much as we're looking for the various assets of the office building or apartment building. For example, what we'll do is say, you have a building, you're depreciating it over 39 years. But what we can do is we can now break out the building versus the carpeting versus the electric versus the plumbing. And those assets depreciate at a much quicker rate. So ideally in cost segregation, what we want to do is capture that depreciation up front and depreciate over a shorter life. So by doing a cost segregation, instead of incremental depreciation over 39 years, what you actually have is a lot more depreciation that's brought forward, which can offset ordinary income.
So on a commercial building, they depreciate over 39 years. On a residential building, which the multifamily is categorized as 27 and a half. If you didn't, so you break out, you allocate a portion of the purchase price of land, and then everything else it would be depreciated over, say, 27 and a half years if it's a multifamily building, or 39 if it's like an office building. And it is kind of straight line divided by 27 and a half or 39.
Exactly.
And the cost said, well, then you take that building, you do a study, and you break it down to its various components. What are the schedules that you can then depreciate over by doing the cost segregation study?
So by doing that, you can break things into 15-year lived items, 7-year, 5-year lived items. And depending on the asset, what we'll do is we'll actually do an analysis before you actually engage us, and we'll take a look at the building, and we'll give you an optimistic and conservative approach to how much we can identify. And then what ends up happening is once we actually do the engagement and go in and look at the building, usually what will happen is our analysis will fall right in between those two, conservative versus optimistic.
Is there any sort of like rule of thumb on, I'm assuming you guys do a bunch of work in Texas, is there any sort of like rules of thumb on a traditional garden style multifamily deal in Texas as far as how much of the improvements can be taken from the 27 and a half year and be put in one of these other categories as far as kind of like a percentage? Is it kind of maybe like a range you can give us?
Yeah, typically it can be anywhere from 5 to 15% can be brought forward. And that is significant depending on the size of the apartment building and such. But that can be brought forward, and then you have that depreciation now in a 5-year to 7-year category.
Got it. Cool. And then so what's basically the benefit? So if I do a cost seg, I just basically get accelerated depreciation, so I can write off what would be depreciation in the future, kind of bring it forward and take that to offset my current income today. Is that the basic benefit of it?
That's exactly the purpose of it. And what's important is you're now saving dollars today, and you will pay out over time the depreciation. For example, over the years of holding the building, ultimately you will catch up with the depreciation. But the idea is to bring that forward and have those dollars today so you can potentially invest them, offset current income, make new investments.
Yeah. And then, so what's always been a great thing that we've been doing for, 6 or 7 years now, seemingly got put on steroids about a little bit over a year ago with the new tax law that got implemented. Maybe talk a little bit about that and kind of the impact on the real estate industry, especially when you're doing these cost segregation studies.
Sure. There are other opportunities too. There's bonus depreciation where you can take an additional amount of depreciation in the first year. There's also asset disposition strategies where we can go in and do what we call an enhanced cost seg study, identify specific assets that will be removed so they can be taken off, no longer depreciated, the new assets brought in, and you can actually depreciate those assets.
So let's break those two down a little bit more. So the bonus depreciation, so specifically the way I understand it is if the new tax law now allows you to not only bonus depreciate new equipment or new real estate, but you can also do used equipment, which would kind of benefit for, already existing and built multifamily projects. And basically anything with a useful life of 20 years or less can be immediately depreciated in the years put in service. Is that accurate?
Yes, it is.
Good. So basically, kind of my experience, we've been, able to take somewhere around 25 to 30% of the purchase price of these buildings, and you can immediately expense that in the year that you put it in service. So if you're doing buying a property and putting 25 or 30% down, essentially you're writing off the entire initial investment, or darn near the entire initial investment, the majority of it in the year that you put the property in service. So that's pretty awesome. And if you are unable to use that loss in year you put it in service, you suspend those losses, carry it forward for future years, and ultimately, if you haven't used them by the time you sell it, it offsets any sort of gain in the future.
Exactly.
Cool. And then maybe talk a little bit about kind of like the recapture. So that's kind of the great thing about it. But the downside. What's kind of some downsides to doing these cost sets?
Well, ultimately, once you get past the 5 to 7 years of gaining that immense amount of depreciation, you will ultimately down the road have more depreciation going into the later years. So you get that benefit up front, which is very important, but later years you're not getting as much depreciation.
Yeah. And then, and I'm sorry, I jumped on you too. You gave us two things. We talked one about kind of the bonus depreciation. What was the other thing you mentioned about?
Asset disposition.
Yeah, talk about that a little bit more.
Or enhanced cost seg study. What we do is we actually go in and identify specific assets that may be slated to be removed from the buildings, so we can specifically identify those, then write those off, and then identify the new assets that are coming in to replace them so that we can start the depreciation schedules on those.
Is that something like abandonment? Is that kind of with the same concept?
Somewhat similar, right, exactly.
Okay, cool. So basically, if you're going in and changing out a bunch of appliance packages in all your apartment units, the cost seg study will identify how much is allocated to that. And then when you remove that, kind of discard it, throw it away, you're able to take the remaining useful life in the year that you abandon it or throw it away, essentially, and then restart it over with the new appliance package over a 5-year period or whatever that would be, right?
Exactly.
Cool. Well, that's good. Paul?
So where does the cost segregation become economical? I mean, what does a cost segregation study cost? How many units should you own? Give me kind of a breakdown of where and when somebody should use a cost segregation.
Sure. Pretty much any building, say over $750,000 to $1 million, is ideal. And just remember, though, when we do a cost segregation study, if you pay $10 million for the building, what we do have to do is back out the land value. So you pay $10 million, but $8 million, say if the land value is $2 million, you're going to have to back out the land value. So what we do for clients, too, is we actually do a land value and get down to the building value and site improvements. So you start with that. So it's basically any building over $1 million. The other thing, too, is it's a recent acquisition, the date of acquisition. You can go back 5 years. There's a lot of options to do this.
Yeah, maybe talk about that. So if I've owned a building for many years now, and I just didn't know about cost seg, so I hear us talk about it on this podcast. How does that work?
Well, typically what we see is most clients, it's within a 5-year range. can go back and do a cost seg. What ends up happening is if you go back a lot further, it's a little bit more difficult because so many different changes have happened to the building, and you've already taken a fair amount of depreciation on the asset. So usually a 5-year range is probably the ideal range.
And then so you can go back and file amended returns and potentially get a refund or something along those lines.
Right. Sometimes people are a little cautious about filing amended returns. So ideally, the best thing is the day you acquire a building, you look and do a cost seg on it.
Yeah, perfect.
Is that how you guys do it, Michael?
Yeah, we always, the year we put in service, kind of towards the end of the year, around October, November, we kind of see what the board's going to look like when the year's over, and we just order cost segregation report for every one of the properties that we bought in that year. So the first time we file a tax return, we're having the building's components broken down into the appropriate useful life.
So again, the cost segregation is the depreciation piece, and the bonus depreciation piece, and you have a lot of these things. How does this work its way down to the individual limited partner investor?
Yeah, so I'll use kind of obviously what we do as an example because we do a lot of this, but kind of a little rule of thumb I was given somewhere between 25 and 30% of the purchase price of the building. It's kind of been my experience that we can then take and write off in the first year. That's anything that has a useful life of less than 20 years. So the stuff that we're able to take, put a land allocation on, and then take anything in the 5, 7, and 15-year categories, and you can immediately expense it, write it off through the bonus depreciation new rule that's enacted this year. And then, like I said, so if you're buying a property, you have about a 70% loan, you're putting about 30% down, and then you're writing off 30% of the purchase price. That's almost 1-to-1. So, maybe 75% or 80% of the initial cash investment in the deal, you're going to, invest $100,000, you're going to get a K1 that shows a negative loss of $75,000, with the vast majority of that coming from the bonus depreciation that the cost seg allows you to do.
I'm not a CPA, neither are you, but what does that really mean to an individual investor that's maybe is an engineer or an attorney or something like that? Can they take that loss?
So if you could reach the holy grail status like I can of becoming a real estate professional, that loss will then be able to offset all sources of income, both passive and active, because as a real estate professional, all your passive losses convert to active losses. So you can offset any sort of like fees you might generate, or if you have a spouse that has a high income. So if you're married to a doctor or lawyer or someone that makes a high income, you guys file a joint tax return, your losses in the real estate can then offset their earned income. And so not that many people can actually qualify, because most people that invest in these deals have, straight jobs and go to work every day. So what they can then do is take those losses off any other passive income. So if they invest in, stocks or bonds and get dividends or interest income or anything that's kind of in the passive category, or you still own a building for a long time and your depreciation schedule's kind of run out and your income's gone up, so it's actually producing positive income, these losses can offset that. And if you can't use it that year, they're kind of suspended and carried forward for future years. So you kind of bank these losses against a potential future sale, or, any sort of future passive losses. And then there's a whole bunch of strategy goes around it. It certainly is worth talking to your accountant, your CPA. And if you can start figuring ways where if you have a lot of this loss, you can convert some of your active income to passive income somehow. If you can pay yourself a consulting fee or something along those lines, you can then start, doing some smart planning strategies and, be able to take those losses earlier on and save the dollars today and worry about kind of the recapture in the future.
So, at some period of time, there's going to be a downside. So what is the downside to the cost segregation for one? And is it come at the end of the depreciation, or does it come at a sale? I mean, when do you have to pay back the money? So
Lewis can jump in if he disagrees with anything I say, but from my perspective is you're saving it today. And if you don't get to use it today, you carry it forward. So you're not giving it up. So if you can't use it today, you can carry it forward. So I don't see a whole lot of downside. The difference is when you have to do the depreciation recapture, the current law, the way I understand it, you recapture at 25%, Paul. So if you're a high income earner, you're making, in the low six figures or up, you're probably in a higher tax bracket than the 25% tax bracket. So for you to be able to offset that income today, that is, taxed at 37%. I can't remember what the top tax bracket is, but something like 37%. And even if you got to recapture at 25%, you're still net positive. So if you're in a really low tax bracket, maybe the recapture is at a higher rate. Paul, that'd be about the only downside I can really think of. But, to Lewis's point earlier, there's also the aspect of time value money. I'm saving, if I have $100,000 loss through the cost seg, and I can then save $37,000, which is 37%. Today, I can then take that money, reinvest it, and get a rate of return on that in theory, and then kind of grow my money exponentially, that if I paid that tax, I wouldn't have that money to invest and I wouldn't get a rate of return. So that's kind of my basic thought. Lewis, you want to expand upon anything I said?
No, I think you said everything very well. And that's the key thing. It's bringing money forward to you. And having that money today is a lot better than having it 10 years down the road. The only thing about the depreciation is, in total, it's the same amount of depreciation. So that in later years, if you have the building, you will be having less depreciation. But if you've done the cost seg, you now have that depreciation right now, and I think that's the key thing for it.
Not to get too deep in the weeds, but we've done a couple of deals where we have one partner, and I've always done the cost seg studies, and then when we sell it, we'll do an exchange, do a 1031 exchange. Do you have any sort of thoughts or things to look out for when you're doing exchanges as it relates to the cost seg from the property you sold and relinquished to the one that you're replacing it with?
Well, what I'm going to say is I'm not a CPA, so I'm not going to give tax advice, but I don't really see too much on a downside on that. We haven't seen too much of that. Pretty much after we've done the cost seg and maybe a purchase price allocation too, then we're not seeing that end result of it like a 1031 exchange or something like that.
Yeah. So, and again, I'm not an accountant either, but my just kind of practical working knowledge through this, that if you sell a property that was on a cost seg, you do 1031, you'll want to do another cost seg study on the replacement property so you can align the categories properly with the 5, 7, 15-year category. And then any sort of depreciation that you've taken on these properties sold will then go and effectively reduce the basis of the replacement property by the depreciation. And again, these are just maybe some talking points and things to think about if you're going to get in that situation, to certainly bring up to either your tax lawyer or your accountant, so you make sure that you're at least having these types of discussions. And these are things that I've experienced in my just kind of tribal knowledge day to day doing this.
Any bullet points for investors to know, Mike, besides the ability to write stuff off?
I mean, yeah, I think that's really just the biggest thing, is you're able to shelter current income. And people listen to this, or you're into multifamily if you're listening this far into this podcast about cost segregation studies. So if at all possible, try to get either yourself or your spouse to become a real estate professional. It really can take, quite a bit of it. And then you as a sponsor, you typically get in a little bit larger percentage of the depreciation as well, that you can then, use that to offset. So you kind of get in disproportionate benefit of the depreciation as well to kind of shelter your income. Think about, maybe we need to have another CPA on. It's been a while since we've done that, but think about, that you make sure you have to have some sort of basis in your investment as well. So not only do you have the basis of your cash invested in it, but you can also get, debt basis by having a loan, because virtually every single apartment complex has a loan on it. It's kind of un-American not to have debt on your real estate, right, Paul? Mm-hmm. So you have that. So you have some additional basis on top of what you invest in. And I don't want to get too deep in the weeds, but those are some of the things that you need to kind of think about when you're doing these deals. And those are some talking points to either read up on or talk to your accountant about.
Lewis, anything that we've missed here in our discussion that you think would be important?
I think earlier on you were asking about fees. Cost segregation, depending on the complexity of the property, can be anywhere from $5,000 to $25,000, again, depending on the complexity of the property.
What would be an average? You have a $10 million apartment in Dallas, Texas. What would it be an average?
We're probably $5,000 to $6,000 to do that.
Bucks.
Yeah.
But on that $5,000 or $6,000 as a line item expense, how big of an impact does that have, Mike?
But I mean, if you're buying a $10 million building and you can write off $3 million or so, you save 37% on $3 million. I mean, that's, certainly more than $5,000 or $6,000.
Yeah, it does not make sense if you have a building, $750,000 or above, not to do a cost segregation study.
Exactly. And on the IRS, it is a recognized way to deal with it. And actually, it's a more accurate way to deal with your real estate asset. Depreciating an entire building over 39 years, really, or 27 years, depending on, does not really make sense in a way. You want it to more accurately reflect what you actually have.
How long does the study take to actually be built from the period of time where you pick up the phone call and the time it's delivered?
It will vary because it tends to be sensitive towards the reporting times. For if you're a 9:30 reporter or a 12:31, those dates can get a little bit busy. It can be like 4 to 6 weeks. It'll take to do the study.
If you're an owner of a building, what do you need to provide you
There's a number of different things, building plans, fixed asset listings, floor plans, any potential bills or new assets that you've put into the property. Everything you can give us about the property, it will just make it more accurate for us.
Yeah, settlement statement from the on the purchase price. And then obviously if they don't do the allocation for you, you need to give them a land allocation as well.
Exactly. And that's what we offer too, is to do the land value, so we can back that out and get to the site improvements and building.
So you build the document, and then Michael, what do you do with that document? Do you bring it to your CPA?
Send it to your CPA, and then they go in and adjust. When you close on it, you'll just typically your management company or you as if you self-manage, you'll just book that as a fixed asset on the books, and then once you have the report, they'll go in and do the adjusting journal entries and take it from just land and improvements, and then break the improvements down into the 5, 7, 15, or 27 F year category. And then, of course, if you're going to take the bonus depreciation, which we've started doing as soon as we were able to with the new tax law, that will then be written off in the year you put it in the first year that you're doing your return, and then you get a big old negative adjustment downward to your income statement, and your equity on your books go down to virtually nothing.
So the bottom line, it's really the smart way of doing apartment investing is making sure that you do have your cost segregation study all put together.
And that's one of the things I think I've not done the best job when we're out raising capital, is really just selling the amazing tax benefits that come along with it. I've always kind of focused on the specific deal and the upside in it and the yield that you might be able to get along the way. But if you can pass along tremendous tax savings to all your investors along the way, it's really takes a already good investment and kind of makes it that much better by having all these great tax benefits.
And it pays for itself.
Yeah, it absolutely pays for itself. And I think there was the debate between Mrs. Clinton and Mr. Trump, where Mrs. Clinton was saying this guy didn't pay any taxes, and all us hardworking taxpayers paid taxes on the deal. And Trump says, that's because I'm smart. I'm in real estate.
Yeah. So if you, Tom Wheelwright's a very popular and prominent accountant. One of the things he always says, if you want to change your tax, you got to change your facts. And this is a good way of changing your behavior, what you invest in, and change kind of your situation. That was one of the main reasons why I started investing in real estate. Was I was just a W-2 stiff. I would make a big bonus and pay a bunch in tax every single year, and it started pissing me off. So I started. My accountant said, "There's nothing I could do for you because all you have is a W-2." So I started changing my activities, and then you change your tax rate pretty quickly if you do that.
That's pretty good. Again, Lewis, anything else that we missed that you would want to bring up?
No, I think pretty much we've covered it.
All right. If somebody wanted to get a hold of you and have you understand a little bit about their situation and maybe hire you to cost segregation, what's the best way for them to get a hold of you?
Sure. They can go to our website, bbgres.com. I'm on the website there. Just give a call and we can discuss your situation and see how we can help you.
What's that website again?
bbgres.com.
All right, perfect. Lewis, thanks for coming in, making the effort to come to Texas. Again, you're out of New Jersey, but it doesn't really make a difference where the heck you are, right?
It does not. I'm all over the country.
Yeah, you could. The property could be in Philadelphia, or it could be in Nevada, it could be in Chicago. It's a federal law,
right? It's tax law, and all 50 states. There's no variation on that.
I hear a lot of people screaming in the background. Something must be on fire, and I think it's cost segregation. So definitely. So, Lewis, thanks for coming in. We appreciate it. The governor himself, Mr. Michael Becker, thanks for coming in.
Thanks for having me.
And I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.